These six financial goals to set before purchasing a home. Look, there's a lot of things to do when you're considering actually buying a new home, whether it's your first home or your fifth home. There's a lot of things to do before taking that initial leap and understanding that getting ready is half the battle. Now, the other half is doing it, but getting ready are certainly important. So evaluate your finances, look at what's out there, understanding what it is you're trying to achieve, how much you're trying to buy, all those things. But to break it down, these are essentially the six financial goals to set before purchasing a home. So, first and foremost, the obvious, right? Assess your financial situation. This includes figuring out a budget, and most people don't have a true form of a budget. I understand that. But even if mentally you're thinking, I want to spend this many dollars per month on my home, again, you are living somewhere, right? But at the end of the day, are you paying something now or whatever your mortgage payment is now? Do you want it to be similar? Are you okay going higher? What's that part where you feel like you're in the range of like, this is where I want to be? Because a lot of that feeling, I'll tell you now, pre 2008, before the mortgage meltdown, so the early 2000s, people would call me and the first question would be, how much can I afford? Since those days, post 2008, people are now coming to me saying, I want to spend X. And nine times out of 10, it feels like nine times out of 10, people are in line with what they feel like they can do. So I would say get that financial situation kind of assessed. What do you have in your savings? What's liquid? What's not liquid? How much do you want for your emergency fund? How much do you think you want to put for down payment? By the way, I would check with a mortgage professional to figure that out, but kind of understand just where you are. Take a quick assessment of the job security, right? Most people aren't going to be calling me to get a mortgage if they're worried about losing their job tomorrow, but still, what's that upside swing for the next 1 to 3 years? Is there room for steady income growth? Do you feel stable? Do you feel like anything can change for better or for worse? So I think that's number one is get to know where you really are financially before really taking that next step. And it may just mean doing 30 minutes of putting some pen to paper or having some understanding of what it is you want to do. So that's number one. Number two, which I'm not going to include in here, but the real number, 1B, we'll call it 1B, talk to a mortgage professional. Call the Mortgage Mark team because at that point, we will help you with the rest of these steps and make sure that we're putting you on a path that is correct and direct and accurate versus you guessing and wandering through the woods on your own. So I would just say at this point, once you've kind of done your financial assessment and understand what you need and think and want, call a mortgage professional and let's do these other steps together. So just throwing that out there. So number one, do your financial assessment. Number two, start looking at your credit, right? You can get free credit pulls. The credit bureaus do let you have one pull per year for free, but they don't give you the scores. That's what they don't tell you. They don't give you scores. You got to pay for those. But again, if you call the mortgage professional, we can tell you your scores based on the mortgage qualifying piece. But let's say you didn't and you want to get your scores up or you want to get them, prepared. One is you can check your credit. You can do that for free and just see what's on it. Make sure that what's there is known and yours. Make sure that you are paying your bills on time, right? Because that's 35%. There's five categories of credit. The number one thing is payment history, and that's 35% of the score. The next biggest one is credit utilization, and that's what says, okay, if you got a $500 balance on a credit card, while that may not seem like much, if it's a $500 limit, you're maxed out, and that's really bad for your scores. So maybe some of those quick and easy fixes can be paying down the debt or calling and getting an increase on the credit limit so that same $500 on a $5,000 limit seems really good and helps your score. So it's wild. It's not even the dollars that you owe. It's that ratio that goes into it. So I think that's the part where just kind of assess your credit because the credit and what shows up on it will absolutely impact your debt to income ratio. So DTI, that's the mortgage acronym, debt to income. And that's ultimately that helps us determine as in the lending industry, how much you can afford. When people say, how much can I afford? That DTI, it is huge. It helped, whatever those monthly payments are for the credit cards, the car loans, the student loans, combined with your mortgage, that's going to ultimately come into the debt to income and that limits you for how much you can buy. So number two is check that credit and make sure you got a really good understanding for what that is. Number three, right? So number one was a financial assessment, start saving for the down payment, get to know what you're doing. Number two, set up your credit and just understand what's on it, make sure it's there and accurate. Number three is you want to start saying, okay, now that I've checked my credit, I know my budget, I got my down payment. The next is start understanding what you want to do in terms of the type of mortgage you want. In other words, like I said in the beginning, like step one, you say, I want this type of payment. maybe now go and we have a home loan toolkit. Check that out to run some payments. Start exploring your options. Do you think you want or need zero down? Do you need FHA? Do you want VA? Just start comparing those things to say, here's the type of mortgage I want. I don't want an ARM. Maybe you do, maybe you don't, right? But understanding what it is that you do and need will help at least you understand. Now, again, I go back to it's hard to do this when you're just sitting there at home on your couch or late at night on your phone. This is why you need to call a mortgage professional to help you with these things. But again, if you want to try to do this on your own, more power to you, because then after you've figured out, okay, well, I want to do a VA loan, or I want to do FHA with 3.5% down, or I want to do zero down, or I want to put down 20%, I want to put down 5%. Once you've kind of got an assessment of what you think you want in terms of mortgage, now you got to figure out like, what's it all going to cost you, right? And that's what are the rates? What are the loan terms? What's that payment going to be? What are the closing costs going to be? Again, difficult to do on your own. Our home loan toolkit will help you, right? It gives you very good numbers, and it's probably the best out there because, again, we created it. So, of course, I believe in it. But that's where, again, do the assessment to see what do you think those things look like in terms of your rates, your costs, your out of pocket, what's left over in the bank. Because again, I don't believe 20% down is the way to go. I think it can be, but people think you have to have it. You don't. I think there's a fine balance between having money in the bank and doing what's right for you, spending the right amount of money. I think those are absolutely the things you need to consider. So, and the last one is get that financial stability. Make sure, like we talked about, number one, you've assessed it, but now make sure you've achieved it. So if you say, man, I need to want to have this many dollars in the bank, or I need to have, I need to have this paid off. And I don't think you have to be debt free to buy a house. I think it's a good goal, depending on what type of debt you have, to eliminate some, maybe all, just depends on the type of debt and what you're doing. But these 6 financial goals are really important to set before purchasing a home, because again, going through and assessing your situation, right? Getting the credit, squared away, lined up, start figuring out what you want to spend, as far as, the type of mortgage you want and how much you want your monthly payments to be. Then comparing that to the rates and the different loan terms that you have within those programs, and then figuring out what your costs are going to be and what's left over when you're done, and truly just making sure you're all set to go. It's a lot, but I'm just telling you, number one, get kind of a rough, here's what I want to do, and think about it for a little bit. And then two, call the mortgage marketing. That's really the freaking easiest thing to do. We will walk you through the rest of these steps. We will check your credit. We will give you a guideline for what it looks like. We will tell you, based on what you tell us in your situation, what you want. Here's the programs we recommend. Here's the structure we recommend. Here's your payments. Here's your cost. Here's your interest rate. Here's all that stuff. We will help do that for you. But again, if you want to do it yourself, more power to you. Just call us when you're ready. You can find us at mortgagemark.com. And remember, as always, when you think mortgage, think Mark.